Hello ladies and gentlemen, a warm welcome to today's webinar where we're looking at how to utilise SAP to create value in these turbulent economic times. I'm very pleased to say that today as our sponsor is Taulia. So I extend to you a very warm welcome. My name is Susie West and I'm the founder and CEO at sharedserviceslink.com. And today I am presenting our speaker, Bertram Mayer, who's the CEO at Taulia. So, everyone's very familiar with how our webinars work. This is a two-way dialogue, and it really is very important that you get the most out of this investment of the next 60 minutes to ensure that you get what you're looking for. Make sure that you think about the question it is that you're wanting answers to, and post that question to me. You can see the box in which you need to post that question. The sooner you put it through to me, the more likely it is it will be asked. And do remember to stay on for Q&A, which will take place in the final 10 minutes of this webinar. Before I hand over to our speaker for today, I just want to touch a little bit on some context and what this session is about. Large corporations, shared services organizations, multinational organizations, currently have a surplus of cash. They're sitting on a lot of cash, more cash than they have been for quite some time, which Bertram will be going into. Conversely, SMEs aren't in that situation, and they actually have a demand for cash. And as we all know, banks aren't necessarily responding in the way that SMEs would perhaps like. In addition to that, companies, especially large corporations, are changing the way that they actually make their investment, and they're changing the way that they invest as investment markets are highly volatile at the moment. With all this in mind, what we're looking at as far as this situation is concerned is the purchase-to-pay organization. And what efficient purchase-to-pay operations are realizing is that this is a situation of opportunity. There's an opportunity here that perhaps we haven't had for a while. And they're realizing that this situation can be converted into a very financially rewarding opportunity. So with that in mind, I'd now like to introduce Bertram Mayer, CEO at Taulia. Over to you, Bertram.
Thank you, Susie. Good afternoon, good morning, everybody. I'm happy to present to you today on how to utilize SAP to create value in these turbulent economic times. First, I would like to speak to you about the agenda for today. So basically, we will focus on the macroeconomic context a little bit at the outset, and talk about the value. Why is dynamic discounting good for buyers and suppliers? Next, focus on the process. How does dynamic discounting work? Then a little excerpt on technology enablers and adoption drivers. How do you get your suppliers to participate? Then we'll talk about the ROI, the impact on profit and loss and balance sheet. Show you two short customer case studies, a demo of how the system works and what it looked like, and then a short summary and wrap up, and then we hope that you will join us for a questions and answer session. With that, to the first topic, the macroeconomic context. Turbulent economic times indeed. One thing that is happening is that growth has slowed down. And Western economies are mostly in sluggish growth, or actually they have entered recession already or are entering recession right now. To say it with the words of the chief economist of Goldman Sachs in the annual outlook, growth is slower in 2012 and 13 than it was before. And at the same time, there is a high uncertainty in the euro area. We all know about the sovereign crisis, a Greek debt crisis that risks contagion other economies. What does that mean for you as a corporate? One thing is there is limited demand growth, so and as a consequence, limited investment in new capacity, limited capital spending in the Western economies, and as we shall see in the following also, that is leading to high stacks of corporate reserves and cash. Economic times as well, we are actually in a very low interest rate environment, historically low. The Fed outlook is that it will remain low throughout 2012 and 13 with max 0.25 short-term interest rate. The Bank of England just kept its rate at 0.5% for the 34th month in a row, and actually markets don't price in a raise in interest rates. The next one is taking place in 2014. For treasurers, that means it's difficult to find investment opportunities that create interesting returns, of course. And as a consequence, the returns on short-term investments and cash are pretty much at historic lows right now. Lastly, looking at the flip side of the coin, the suppliers. Actually, for suppliers, small and medium businesses, the situation looks different. Just quoting a recent Telegraph headline that's actually been based on an analysis if UK banks are actually hitting their small business lending target, and they're actually failing to do so. And that implies that suppliers are actually struggling to find cash and resorting to a lot of different financing mediums. And of course, that situation is exacerbated by weak post-crisis balance sheets. To have a look and quote an external source here for all that I'm telling you, this is a news article based on a Deloitte report. Corporates in the UK holding, and this is non-financial companies, holding over 730 billion in cash right now. And according to the study, they're planning to hold on to that cash as an insurance policy in the current uncertain environment. So there is no evidence for an increase in spending, just in line with what I said. This is not linked to the UK. It's a worldwide phenomenon. Record cash levels in the US too. Their corporate cash balance have actually reached and exceeded $2 trillion, which is an increase of 36% over 2009, and also is a historic record in the ratio of liquid assets to short-term liabilities. So very interesting times indeed, and that brings us to the first poll question where we'd ask for your participation. I'm handing over to Susie for that.
Thank you very much indeed, Bertram. So coming up on your slide, on your screens now, ladies and gentlemen, if you could respond to the following poll. What are the returns you are generating from your cash and short-term investments today? Is it less than 1%, 1 to 2%, 2 to 4%, or indeed more than 4%? Just as a note here, please do make sure that you do participate in these polls. We do use these opportunities as benchmarking opportunities. So the more of you that participate, the more meaningful the results. So we're on about 50% of you responding. If you haven't already responded, please do so. Just to repeat the question: what are the returns that you're generating from your cash and short-term investments today? Less than 1%, 1 to 2%, 2 to 4%, or more than 4%. Closing the poll in 3, 2, 1. Let's have a look at the results. Just shy of 60% of you responded there. So coming up on your screen shortly, you'll see the results. So we've got 32% coming in less than 1%, 44%, 1 to 2%, and 0 at more than 4%. Interesting results there. Back to you, Bertram.
Yeah, and this is fairly typical and representative for the corporate environment. Treasuries are seldom given the task to do risky investments, and so short-term investments typically in low-risk bonds or money market funds. So what we see is some of you actually manage to make more than 1%, which is not an easy feat in this environment. And the third, what I would have assumed is more typical, below 1%. Nobody, obviously, above 4%. So that points to the struggle that I have been pointing out of corporate treasurers trying to find meaningful investment opportunities, of which dynamic discounting is certainly one, as we shall see in the course of this webinar. Coming to the next topic, and again, the flip side of the coin, the situation is very different for suppliers. And the best indicator for that is the factoring market. Now, factoring means that suppliers are selling their accounts receivables, which is basically outstanding invoices, to financial companies that are called factorers. And the market has been growing very strongly. In the UK, it's close to 190 billion pounds a year worth of invoices that suppliers are selling to factorers. Worldwide, it's actually 1.65 trillion euro, huge amount, and you see the growth rates of plus 16% in the UK, plus 28% worldwide. UK is actually one of the largest factoring markets per GDP, and so the world is catching up a little bit to the factoring volume that we're already seeing and used to in the UK. All this is very expensive for suppliers. Factoring costs can be very high, can exceed 20% a year, depending on the volume and the balance sheet and other factors. In the US, many actually, according to the Fed, run on credit card borrowing, which is very expensive too, around 18 to sometimes 20% APR. Purchasing card, another kind of payment method, typically comes with a 2 to 2.5% top-line fee. And bank debt, as we have seen, difficult to turn as banks are not meeting their lending target. So for suppliers, there is a struggle in obtaining sufficient funding and finance. Let's see how dynamic discounting can actually help both buyers and suppliers to monetize this situation and this arbitrage opportunity. As should be clear from the factoring market, suppliers are quite willing to offer discounts for earlier payments, but they're not doing so today. Actually, only 12%, according to a PayStream study, of invoices contain discount terms. Question is, why is that? There's actually 3 to 4 reasons on that. First, suppliers have moved away from that because some buyers have abused those terms by actually paying at due date or even late and still taking the discount. Second is it doesn't really fulfill their needs. It has very low payment predictability because if the buyer approves the invoice inside the discount window, then you get paid very early. If the buyer doesn't manage to approve the invoice in that window, then you get paid at net. And so as a supplier, you don't really know when you will receive the cash. And then the third point is an important one too. It's actually not kind of being offered to the person who is in need at the point in time of need. Let me try to explain what I mean with that. There's actually 2 negotiations taking place in a true setting. One is at the point in time when a large organization purchases goods, and that takes place between the procurement department and the sales department of the supplier. And there they discuss, delivery schedule, quality, price, and payment terms, to just name a few of the elements that are part of that negotiation. The second thing that's actually taking place can be half a year later, the goods have been delivered, and that's a negotiation between the accounts payable department and treasury department of the large buying organization that know that they have cash, and the accounts receivable department and cash management department at the supplier that need the cash. So those are actually 2 decoupled and largely unlinked things. How does dynamic discounting help here? Well, it helps you tap in the opportunity that exists between invoice approval and the average payment terms. Now, what is typically happening is invoice can be approved within 15 days, and e-invoicing, as we shall see, and workflows are actually driving that number down, as does a good 3-way match in SAP. And payment terms, on average, have been moving out, according to REL consultancy amongst Fortune 500 companies. It's 56 days as an industry average. I've quoted some terms that are public of companies, both in the US and the UK. Texas with client standard terms, 60 days. So that creates this opportunity between, approval date of an invoice when you know that you're going to pay and the contractual payment term for net invoices. During that period, well, large buyers, you have investment grade rating mostly, very good access to capital markets, high liquidity, and the approved invoices sit idle until due. For small suppliers, as we have seen, high days sales outstanding, high working capital requirements, no access to capital markets, and financing expensive and difficult to obtain. So this is truly the opportunity that dynamic discounting is monetizing. How does that work? Well, you need to tap into those 88% of invoices that are being paid based on net terms and make those subject to discounts too. Currently, just to hit that point home once more, shared service organizations benefit and could benefit, but the banks actually are making that margin between the money market account earnings of 1%, or as we have seen in the poll, maybe 2%, and suppliers that factor at, let's say, 18%. So that's their margin. That's also for, of course, accelerating the payment and for taking on some risk, which a bank takes on because they don't know if the buyer will pay. But in the arbitrage opportunity for the buyer, that's not truly there because you know that the invoice is approved and will be paid at due date. So how can dynamic discounting solve those issues? It enables you as treasuries and shared services organizations to generate recurring multi-million savings by paying suppliers early in exchange for a discount. And it offers suppliers a less expensive alternative to factoring by accepting time variable or sliding scale discounts on earlier payments, earlier than agreed. How are they different from what is out there in the market? Well, it's not a short-term loan, of course. It's not a credit line you're extending to suppliers. It's a payment for delivered goods and outstanding invoices. So as such, think of it as a change request on a payment term. It's not factoring. That makes a huge difference because it applies to invoices of all sizes worldwide. It can be agreed with one click, basically as an online change request. Payables are accelerated, they are not sold. So in the dynamic discounting pure case, the liquidity comes from you, the buyer, not a third party. And payment is based on the entire invoice amount, whereas factoring, you typically get paid out only 90% of the face value of the invoice, and the factorer, we told 10 to 20% until he receives the money from the buyer. It's also not traditional discounts, because it applies to a much larger portion of annual spend. We'll see how we can include those net invoices in scope. The buyer has control in real time. You basically make an offer, hey, I could pay you early against the discount, but you can decide basically on a daily basis, if you want to, on the interest rate and on the liquidity that you have available for this program. How does it work? How does the process work, and how can you include net invoices in the scope? Let's have a look at that. The first thing is that we introduce a portal or a platform, our SaaS platform, as an electronic exchange means between you, the buyer, and your suppliers. Now, that may sound like a constraint, but it truly is not. It provides huge value both for your AP departments as well as for the supplier, because it gives 24/7 visibility on outstanding invoices, purchase orders, how much can I still invoice against the purchase order, visibility into payments, and so it allows for a lot of comprehensive self-services which are valued both by your AP department as well as by the supplier. How does it work to actually now leverage that for discounts? Well, you as a finance organization can set up the interest rate. That can be one interest rate for all suppliers, or you can segment suppliers. It's basically your demand rate for cash, and you can decide which suppliers are in scope. Then the software solution automatically registers when invoices are approved for payment and automatically offers those for earlier payment to your suppliers. Suppliers can now select the payment date. They have to accept the discount. The discount is, of course, calculated based on the rate that you have set for the supplier times the days the payment is advanced, divided by 360. or 365. And then we actually kind of take care of payment in according to these terms, typically through your standard SAP payment method. So payment for the reduced invoice amount and at the earlier agreed time to honor that online agreement and earn you the discount. Comparing that to traditional discounts real quick, and I just took one example discount, 2%, 10, net 30. There's a multitude out there, and they differ a little bit country by country. The problem with a traditional discount is that the invoice approvals, happen on a distributed curve. So as an example, the bell curve here, sometimes the discount, the approval happens within the discount days, and then you're entitled to a discount. Sometimes the approval happens late. You're not entitled to a discount anymore. So it's a little bit a hit or miss discount. Dynamic discounting allows you to put that on a sliding scale. So you can actually migrate traditional discounts to that and agree on a sliding scale. That also allows you to capture a higher discount for approvals that come earlier within the discount days. We actually have one client who makes both close to $1 million annual just from suppliers who accelerate into the left upper triangle above the 2%, which is a very interesting value proposition. Also, this is, of course, time dynamic. The earlier the approval, the higher the discount. The later the approval, the lower the discount. But even if you don't approve within discount days, you're still entitled to a discount. It's also a very fair value proposition because, suppliers love to buy into that because they're not risking to get paid late and the discount is being withheld nevertheless. And of course, dynamic discounting is flexible regarding the slope of this sliding scale. For net invoices, you might, deploy a different underlying interest rate. So this actually brings us to the second poll. Now that we have seen how dynamic discounting works, we would like to understand what is of interest for you in terms of liquidity. I hand back to Susie for the poll.
Thank you very much indeed. Bertram, so on your screen now, ladies and gentlemen, what uses of excess liquidity are of interest to your organization? This is multiple choice, please, so don't feel obliged just to tick the one. Maintaining reserves in an uncertain economic environment, mergers and acquisitions, paying down debt, boosting dividends to shareholders, or generating higher returns on cash, for example, by use of dynamic discounting. So just to repeat that, it's a multiple choice, so don't just, if 2 or 3 jump out at you, please feel free to tick 2 or 3. What uses of excess liquidity are of interest to your organization? Maintaining reserves in an uncertain economic environment, mergers and acquisitions, paying down debt, boosting dividends to shareholders, generating higher returns on cash. 54% of you have voted. If you haven't already voted, please do so. I'll be closing the poll in 3, 2, 1. So we stayed pretty much at 54% there. So let's have a look at the results. And there's a very, very clear winner here with 72% coming up on your screen now. So you can see here that the clear winner is generate higher returns on cash, and the loser in that particular poll question was mergers and acquisitions. Back to you, Bertram.
Well, thank you. Thank you, Susie. Very interesting results indeed. So, of course, that speaks volume for what I'm presenting today. Generating higher returns on cash is actually a cool focus for treasuries right now, and I'm happy that that there is an alignment of interest. Just speaking very, very quickly to the other topics as well. All of the uses are, of course, legitimate. The interesting thing here is that even if you want to maintain reserves in an uncertain economic environment, or you're planning for an M&A opportunity, well, in both those cases, you can still use dynamic discounting because, again, you're investing locking in invoices for the time between approval and due date, so max 45 days. And if you turn off the program, you can free the cash after 45 days. Now, typically, if you do an acquisition, you're not getting surprised by it, which means you can actually phase out the dynamic discounting program before an M&A opportunity. But very often they drag on for a while, and during that time you can actually earn double-digit returns on your cash. Same for the uncertain economic environment. You can actually free the cash if you need to. So only if you want to pay down debt or boost dividends to shareholders, in that case you have a different use of cash. That's totally legitimate, just that paying down debt usually earns you less interest than what dynamic discounting does. Next we want to speak a little bit about technology enablers and adoption drivers. As this is a treasury-focused webinar, I'm just going to speak a little bit about it. The interesting thing is that the solution we have is SAP-centric. So part of it actually resides inside your SAP system as a certified add-on, fully SAP certified. And that gives us access to all invoices and actually all purchase orders and payments, which means that we can offer the entire spend to your entire supplier base for dynamic discounting, no matter how the invoice was received. That means it could have come in through the portal, through an e-invoicing network. It could be ERS, evaluated receipt settlement. It could be EDI invoice, PDF invoice, paper or fax invoice. All of those can be exposed to your suppliers, which allows us to get to the entire spend and make that subject to the value proposition. Interestingly, the same element, the same SAP centricity, also allows us to get around the implementation risk and effort, because we actually have kind of insourced that topic of getting data interactively between the SAP system and the web platform that is being accessed by the suppliers. It's all part of the SAP certified standard solution. The second thing is about supplier adoption. Now, what we find is that it depends, adoption and stickiness usually depend on the supplier value proposition. So a combination of e-invoicing, visibility, early payments, is a secret for good supplier adoption. So what suppliers love and what we offer is free compliant e-invoicing, either through file uploads or by flipping a purchase order, multiple submit mechanisms, access to early payments and dynamic discounting, 24/7 visibility into accounts receivables and purchase orders. You may not know, but the most frequently asked questions to your account payable department is, have you received my invoice? What's the status? When will it be paid? You can actually have suppliers answer those questions for themselves. And then multiple up and download formats, kind of in the to the liking of the supplier, and comprehensive support. What suppliers hate is paying for that. Free is an important driver of adoption. Also, it makes onboarding easier because we don't need to capture the credit card or billing information of a supplier, and therefore do not need to bug them with that. So these are the two key drivers that we find. Coming to ROI next, and impact on profit and loss and balance sheet. Impact on the bottom line. I would like to just pick one example and compare the use. Here I've chosen euro, 400 million euro in cash. Well, if you invested at 0.3%, let's say money market, we've seen that a third of the poll audience actually achieves less than 1% returns. That generates 1.2 million in annual interest. You can also accelerate 2.4 billion in payables. Here I've assumed that you accelerate the full 60 days of payables at 15% interest. Now that would be the demand rate that you have set as a Treasury department, in which case you can earn $60 million in additional discount, or 50 times more than putting that money in a money market account. What does it mean for a balance sheet? Well, let's have a look at a balance sheet of a $20 billion spend company. And I've just taken here the relevant entries. So there is assets of 3.6 billion, liabilities of 1.8 billion, and with the cash, they generate here an interest of 9 million. That's again, yeah. Now, that is, you know, the 9 million is in line with what we've seen before. Now, what you can do with 400 million is pay down 2.4 billion in earlier payments. That reduces cash by 400 million, so it goes down to 3.2 billion. You pay down accounts payables, so those go down by 400 million to 1.4 billion. But you're earning actually 60 million in discounts. Interest goes down to 7.8 million. That means your net benefit here is $58.8 million. So what you actually did is you traded a little bit balance sheet into a huge impact on bottom line, now earning 50% interest on your short-term cash. So think of it as an alternative form of short-term investment. You take cash, invest it, get 15% return. The maturity period is basically equal to the average days that your invoice payables are accelerated. And it's important to know it stays an option, not an obligation. You're not entering a contractual obligation to forever pay quicker, and so therefore you can truly treat it as an investment method. So summing it up, there's benefits for multiple stakeholders in running this program. For Treasury, it's of course very interesting, the ability to generate double-digit returns on short-term cash. It's flexible and it can run automatically. We actually allow for a lot of features. Basically, you can make your interest rates fluctuate with market interest rate such that you don't need to do that in person. For procurement, it's the ability to scale payment discounts across 100% of the supply chain. For financial ops, it's leveraging the supplier self-service for impressive cost reductions and reducing incoming supply inquiries and benefiting from free invoicing. And then for IT, it's of course leveraging the past investment in SAP, and then very rapid deployment with limited drain on internal IT resources by the means of a certified, SAP certified standard solution. Customer case studies. So we thought we'd show you two examples of customers. The first one is Coca-Cola Bottling, the largest independent bottler. And I took some quotes from a CFO Journal article with their AP director. So midterm, when fully ramped, they're actually targeting to save discounts that reflect over 1% of company earnings. So such a program can be a significant contributor to the bottom line. Key challenges they had was, at the outset, lack of visibility. They didn't see that as a cash flow opportunity. They also were decentralized. We actually partnered with AP to drive the additional savings and help them determine supplier categories to optimize the interest level. Enrollment was very quick. We get to over 50% of the in-scope suppliers within 5 weeks. So I think that is a testimonial. The next case study is even more interesting and more impressive in terms of adoption rate. That's actually Pacific Gas and Electric, one of the largest utilities on the West Coast. Just a quote from their accounts payable manager, Ben Sheffer: "If you're running SAP, Talia is just impossible to beat." They actually had a previous solution provider that was starting to charge supplier fees, so that was one of the motivations to move away. Also, they were offering dynamic discounting only on 55% of invoices, which were the electronic invoices, and not doing so on the EDI invoices and the paper invoices and the ERS invoices. PG&E saw a huge pushback from suppliers on the introduction of fees, and so therefore wanted to move to a different provider. We actually went live 3.5 months after contract signature. That speaks, testimonial to how lean that is. In that, I think there was 8 weeks of user acceptance testing, so the deployment in itself was very, very quick. 99% of the suppliers that were using the previous network transitioned within 5 weeks. And the additional discounts of the first 5 months is more than 10 times the annual license. So the ROI is actually more weeks than months or years. So very impressive results, and we would, of course, be looking forward to see and have a business case exercise with any of you to see how that can be replicated. This brings me to a very short demo, trying to show you what a system looks like and how the flow is. We have just taken an example person, Max here. The bank has pulled his overdraft facility. He needs to make payroll. So he's actually looking to accelerate some outstanding invoices and wants to do so via dynamic discounting instead of factoring. Also wants to submit some invoices for already shipped goods electronically, and of course overall reduce day sales outstanding, improve his cash flow, because this is important metrics for him to regain the creditworthiness from the banking sector. So this is the portal view for Max, supplier portal, where actually Max now, as a supplier, has access to the outstanding invoices. You see at the top a couple of quick links to the most important functionality, and a featured window of approved invoices that are actually approved and available for earlier payment. We'll get there in 1 second. Scrolling a little bit down, you see there is on the home screen access to dispute messages and purchase orders. You even see which purchase orders are new, which ones are invoiced already. And before we go to doing any actions, just quickly scrolling through the menu here, you see as a supplier I have access to purchase orders, shipments. I can create advanced shipping notices, invoices, of course, multiple ways to submit or upload or key in invoices depending on what is the most convenient way. Jumping a little bit further, my details, the ability to maintain bank information, address, tax identifier, and of course, Talia is syncing that information back to you, the buyer. And just to mention that we, of course, have the ability to brand this interface according to your company if that is so desired. Going into the early payments here, this is an invoice. Invoice date is 19th of February. Due date is 19th of April. So there is a kind of a huge still remaining period where the invoice is approved but not yet due. As a supplier, I can go in here, select the payment date, February 23rd, and the system automatically calculates the discount percentage, discount amount, payment amount, and I can submit, agree to this discount and the change in payment method here and be done. Of course, this is sliding scale. If I select a later payment date, the discount amount and discount percentage are lower. This is the underlying sliding scale. I can agree to this payment here and be done. Just looking at another way of doing the same thing here, Cash Planner, that's actually looking to be a tool for the supplier. I can go in here as a supplier and say, well, I run payroll. I actually need $220,000. Can you show me the invoices that are available for this amount here? The system selects the invoices that come closest to the target amount. So they may have different acceleration days. You see one is accelerated 50 days, the other one 51 days. I can, as a supplier, then easily just, add another invoice to that and accelerate 3 invoices with one click. Moving away from this to the purchase orders, just to show you that real quick, I have, of course, access to my purchase orders. So most recent purchase orders, and I can see purchase orders in any particular status or download them. And I see which actually is the invoiced value. What do I already have invoiced against the purchase order? What is still open? And that's very valuable information for the supplier because it's information coming from you, the buyer system. So they know what actually you have already on record. And I can, just to do that example here, of course, also create an invoice against such a purchase order by flipping the purchase order. That brings us to the PO flip screen. It's basically, for those of you familiar with SAP, like exposing Miro to the supplier. So you see there is already the line item and the invoiceable quantity being suggested. That is information coming out of your SAP system. As a supplier, I have to enter a unique invoice number. And I can adjust the quantity if I want to. Then we recalculate the line total based on the unit price. I can upload and attach attachments, freight, and so on. You can allow them to handle that, and then with one click here, the invoice can be submitted, and is done. Just to show you, a little bit of the depth, there is, of course, other ways of doing things. Suppliers can upload invoices, so I can just here browse my desktop to find a file of test invoices. Suppliers can actually create their own mappings. So we have a self-mapping engine. You do that once, and then it works for the future. And you can upload any number of invoices here. You see that there's actually automatically a check done. So I uploaded 2 invoices. One is accepted. The other one was rejected, but there's the ability to make corrections. So I can actually go into that uploaded invoice here. Well, the problem is I've used that file before, so the invoice number is not unique here. So I need to change the invoice number here, adding SSL, and then I can submit the invoice. So now I have 2 valid invoices. I can confirm, save the invoices, and be good here. So this basically just a short excerpt of what can be done on the supplier portal. I'm not going to bore you with the complete functionality. Happy to have that in a separate, customer-specific online demo or so. That brings us to the buyer view. Now, as a buyer here, I have a user interface inside SAP. That's our certified SAP add-on. Looking down here, you see /Talia/invoices. That's our own namespace at the lower right-hand side of the screen. It is within the familiar SAP user interface and, of course, tied into all the SAP functionality. So, yeah, there's the invoice. You will note that invoices can be received and submitted into workflow, or they can post or park automatically, depending on the rules as defined by your accounts payable department. That brings me to going to reporting. Of course, we have extensive reporting capabilities and everything that's going on. The analyzer is actually a tool to calculate the invoice approval cycles, so you know how much you can actually accelerate invoices on average post-approval. The group monitor is where you can set interest rate settings for the suppliers and segment suppliers. There is a supplier dashboard to have a holistic supplier view. The dynamic discounting, individual dynamic discount, is actually the audit trail. So each and every invoice and option for a discount is registered there, including the underlying invoice. Treasury review is treasury reporting, of course, and I'm just going to kind of go here as an example. What we do in here is basically calculating a profit and loss statement. So you can say, what is my opportunity cost of capital? As we have seen, for many it's below 1%. For I think the majority it was between 1 and 2%. You can enter your cost of capital. We calculate your cost. We calculate your benefit from dynamic discounting and the net profit, such that at any point in time you have a justification of the program you're running. With this, I would like to wrap up the demo and come to the summary here. The summary and wrap up on how you can create value from SAP in these economic times. I hope to have shown you that there is cost of capital differences between you, who actually have between 1 and 2%, and suppliers who actually factor 1.6 trillion euro a year at very high double-digit rates, and that creates a multi-million-dollar or pound or euro win-win opportunity. Dynamic discounting can actually scale to the entire spend, which means it does not need to exclude net invoices, but you can actually have your suppliers opt for that to apply to net invoices too. Benefits and the secret to adoption is free e-invoicing, visibility, and combining dynamic discounting together with other e-invoicing and supplier network, supplier portal, supplier interactivity kind of capabilities. It's important that the capability applies regardless of how the invoice is entered into SAP. It's only creating value for a supplier if they have access to all their invoices and not just part of them. And then connecting to the software as a service platform through certified SAP add-on is, of course, best practice. It's SAP certified and eliminates implementation effort and risk. And lastly, there's a compelling ROI in 5 months, sometimes 5 weeks. So that can be realized very, very quickly. With that, I would like to hand back over to Susie for moderating the Q&A session.
Thank you very much indeed, Bertram. We have a lot of questions that have come through, so let's try and make our way through as many as possible. So the first question for you, please, Bertram. If you manage dynamic discounting on a daily basis by a supplier, is this a high maintenance process for a large organization?
No, actually, that's a very good question, but the answer is no, it's not high maintenance. We have a lot of buyers that did the discount management strategy together with us, so that is part of our normal program, is that we do a 1 to 2 day workshop and develop a discount management strategy with you. Also a supplier segmentation and rate setting. And for many buyers, that just stays in place and is not being modified and runs very, very successfully without any touch points on a daily basis. What some buyers do, I mentioned it briefly, is they actually do kind of make their interest rates fluctuate with market interest rate environment, so you can tie it as a markup over LIBOR or Euribor if you wish to, and that takes out the need to manage anything on a daily basis very easily.
Okay, good. How does the Taulia solution work with e-invoicing platforms or solutions? The follow-up question is that there would be a reluctance for a company's suppliers to go to 2 portals. How do you manage that?
Well, yes, a very good point. 2 things. One thing is you can, of course, use, if you don't have anything in place yet, Taulia simply for e-invoicing too, in which case it is obviously your unique platform offering everything, including e-invoicing. However, we realize that in the market, some people have built a proprietary portal or already rolled out a supplier network, which is why we have created both an API and a widget that allows us to inject the dynamic discounting capability into a third-party networks. So we're partnering, to just name one, for instance, with OB10, and can provide dynamic discounting in the OB10 network too. So we can actually provide that and leverage the fact that you may already have registered suppliers for a specific e-invoicing solution that we don't need to restart adoption.
Good, thank you. Can you elaborate a little bit more on the supplier adoption of this solution, i.e. speed, kind of deployment ROI?
Yes. So I gave two examples in a case study that's very representative. Typically, if we have valid email addresses to suppliers, already the first kind of e-enrollment campaign, because it has a huge value proposition for suppliers and is free, yields within 3 to 5 weeks very impressive results of 25 to 50% onboarding without a single manual touch for the service. And then, of course, we can do kind of a telephone campaign, and we have a deadline for signing up and reminder management to drive the adoption higher than that. In the end, it's a little bit influenced by the quality of your data, but we can also perform data cleansing services in order to improve that. As soon as we have valid email addresses, the onboarding time and speed is extremely rapid.
Okay, good, thank you. Can you use part your own cash and part bank kind of provided cash to fund the dynamic discounting?
Yes, so the solution has that capability in a very, very flexible way. So you could actually say, today I use my own cash and tomorrow I use the bank, or for these suppliers I use the bank and for those I use my own cash, or up to whatever, 20 million I use my own cash, and above that the bank. There is one little caveat though, which is dynamic discounting is very, very powerful because it can be rolled out to any supplier without constraint, no matter the supplier size, no matter the invoice size. So it's very well suitable for the long tail. When you switch to bank funding, typically many banks still require kind of at least one-time contract signature by the supplier, and some banks require that being done in real ink, so they fax a contract to the supplier to get it signed. So that means that it is actually best practice to, if you want to have a mixed funding, to have bank funding or supply chain finance or reverse factoring or however you want to call it for a set of your large suppliers, and then operate on the long tail with your own cash.
Okay, good. You talked about a collaboration there with one particular e-invoicing provider. I will, however, ask this question. Is this solution generally in competition with e-invoicing solutions, or are you specifically kind of campaigning to work in collaboration with e-invoicing platforms?
Well, our philosophy is open. We're an open platform that connects with any player and solution that is around, be it a portal developed by a buyer, be it other players. We don't charge for the e-invoicing services, neither if we provide it directly to suppliers in a compliant way, nor if we take invoices that are generated on another network. So we're not introducing an additional charge. We have a very powerful out-of-the-box link into SAP. So what we strive to be is the unique channel for interactive communication into SAP and out of SAP that's actually not limited to invoices, but also to outgoing purchase orders and dispute messages. So the answer from my perspective is we're completely open, and whatever setup solves the client's problem best is the right one for us.
Okay, good. We've only got a couple more minutes, ladies and gentlemen, so if you haven't asked your question, please put that through to me now. You touched on this in in the actual overview, but if you could just maybe go into a bit more detail. The question is, how can this be integrated into an existing e-invoicing, vendor portal, AP automation, OCR solution?
Yeah. So there's two integration points in that question. Let me start with the front end and then get to the back end. So first question is, how can it be integrated into an existing vendor portal? There's basically, technology-wise, there's two things that we do. One is we have created what we call a widget. That's a little kind of piece of code that you can embed into any portal, and that creates this little early payment pop-up. So the Pay Me Early button and the underlying pop-up that allows the supplier to say, yes, I accept the discount. It injects that without requiring coding at the side of the portal provider. That's one way. The other is we have kind of all the data of we're providing an early payment and the interest rate available through the API, which means there is the ability to connect to the API and then expose that data to the supplier via another network. And of course, in networks, we have already realized that integration, which means no work needs to be done at all. We're actually, live and transacting for actually even Fortune 50 companies in combination with our partner OB10 as one example. The second thing is the backend. You asked about workflow and OCR. So we have a standard connectivity into all the SAP-based standard workflows, be they the Resoft Invoice Cockpit or Dolphin or OpenText or SAP Business Workflow, whatever workflow solution you have. There is kind of an out-of-the-box adapter that we have that ties into, which allows us to expose the workflow invoice status to the supplier through the portal and to feed incoming e-invoices, whether they come from us or a third party, directly into that workflow, or as we have seen, if they are PO-based and there is a perfect three-way match, we can post them automatically.
Final question for you, please, Bertram. So this is connected to the languages that Taulia supports, and also that this is ready in Europe. So is the solution, is it ready in Europe? And also, can you just give us an idea of the kind of the languages that you support? For example, do you support French language, Italian language, Chinese languages, etc.?
Yeah. So yes, the support, the solution is ready for use in Europe. We're working with TrustWeaver, which is the market leader, to continuously monitor compliance across all the countries, and where needed to provide an electronic signature. So this is all done in a perfectly compliant way. We have, I think, 50 currencies that are being transacted through the platform. We're transacting more than $50 billion a year. And languages, I think we have 13 right now. That includes, of course, English, both UK as well as US. French, German, Italian, Spanish, Dutch, Portuguese / Brazilian, and so on. We are working on Asian languages right now. So that will actually go live this year.
Bertram Mayer, CEO of Taulia, thank you very much indeed. And if you'd like to speak directly with Bertram, or if you'd like to speak to Seb Chelvers, who heads up the European operation, the contact details are there for both of them. So thank you very much indeed. Just before we wrap up, just want to remind you that we have a very exciting and full webinar program coming up over the next